Silver just witnessed one of the most shocking market moves in recent memory. On January 30th, 2026, after a spectacular rally that was pushing prices toward an incredible $120 per ounce, the silver market suddenly crashed, dropping over 15% in a single day. Investors and traders all over the world woke up to a tidal wave of selling that wiped out an entire week's worth of gains, sending waves of panic through both retail and institutional markets. It was a bloodbath, plain and simple. Now, while all the headlines are screaming about that 15% drop, the real story lies in the reasons behind this crash. What happened today reveals some incredibly deep tensions simmering beneath the surface of the silver market and the wider financial system. So let's break down the three main culprits that caused this chaos. First, and most obviously, we have profit-taking. It's human nature. Investors who got in early on this massive rally saw their profits soaring and decided to cash out. They rushed to lock in those gains, and this created a snowball effect. One person sells, the price dips a little, which spooks another investor into selling, and before you know it, you have a cascade of selling that feeds on itself, turning a small dip into a full-blown crash. Second, we can't ignore the macroeconomic picture. A stronger US dollar played a huge role. For buyers overseas, a stronger dollar makes commodities like silver more expensive. So, when the dollar strengthens, international demand for silver tends to cool off. On top of that, there's been growing speculation and rumors about potential changes in leadership at the Federal Reserve. Any hint of a shift in Fed policy can send jitters through the market, and that uncertainty definitely contributed to today's sell-off. The third, and perhaps most explosive factor, was what happened in the futures market. This is where the technicals and leverage come into play. Many large traders use borrowed money, or leverage, to control huge positions in silver futures. When the price started to fall, it triggered what are called margin calls. And this is basically the broker saying, hey, your position is losing too much money, you need to deposit more cash right now, or we'll sell your silver to cover the losses. This forced liquidation creates a brutal domino effect. As these big players were forced to sell, it flooded the market with sell orders, pushing prices down even faster, which in turn triggered more margin calls for other traders. It's a vicious cycle that can turn a correction into a catastrophic collapse in a matter of hours. So, when you combine massive profit-taking, a stronger dollar, and a cascade of forced selling for margin calls, you get the perfect storm we saw today. A soaring rally was turned on its head, becoming a sudden and violent correction. But beyond just the numbers, this crash shines a massive spotlight on a long-running battle in the silver world. The tension between the paper silver market, the futures contracts and ETFs, and the physical silver market, which is the actual coins and bars people hold in their hands. What's fascinating is that even as the paper price was plummeting, reports were showing that demand for physical silver remained incredibly strong. This disconnect is crucial to understand. Today's event is also a very harsh reminder of just how volatile precious metals can be, especially in the short term. When a market is fueled by speculation, high leverage, and macroeconomic news, you have to be prepared for extreme swings in both directions. Those incredible gains we saw over the past week came with an invisible price tag, the risk of extreme volatility. For every investor, trader, or even just someone watching the market from the sidelines, what happened today is a major wake-up call. It's a call to understand the mechanics behind silver's price movements, to resist the urge to panic sell, and to accept that massive rallies often come hand in hand with sharp, painful corrections. Now that we've dissected why silver crashed over 15%, the really big question is, what does this mean for you, the investor? And more importantly, is there a hidden opportunity in all this chaos? First things first, let's get some perspective. Silver has historically been one of the most volatile metals out there. It's known for its explosive rallies and its sudden, gut-wrenching corrections. So an event like today, while dramatic, is not entirely out of character for silver in the long run. These moments are actually critical lessons for anyone invested in the metal. So if you're holding physical silver, the actual coins and bars, this drop is not necessarily a signal to hit the panic button. In fact, it might be the opposite. As we mentioned, physical demand, especially from industrial users and retail collectors, is still very strong. This creates a gap between the paper price you see on the screen and the actual price to get your hands on physical metal. This gap can sometimes present an opportunity to acquire more silver at a relative discount before the next rally potentially kicks in. Now, for traders in the futures market, today was a brutal lesson in the dangers of leverage. Margin calls can wipe you out in the blink of an eye. In a market this volatile, timing is everything, and being over-leveraged is like playing with fire. It can be extremely dangerous. Let's look at history for a moment. In past bull markets, we've seen similar corrections. There have been times when silver hit extreme highs, only to suddenly drop 10, 15, even 20%. But what often happened next? Within a few weeks or months, the metal found its footing and resumed its upward trend, driven by that persistent physical demand. and the same macroeconomic pressures that were there.
The third
all along.
and perhaps most
This
explosive
explosive
factor was
suggests
what
that
happened
while
in the
today was
futures
painful,
market.
it could
This is
actually
where
be a
the
technical
technicals
and
and
buying
leverage come into
opportunity
play.
for those with a long-term
Many large
perspective.
traders use
This
borrowed
brings me
money
to another
or leverage
crucial takeaway
to control huge
the importance
positions
of
in silver
diversification
futures.
and patience.
When the price started
The volatility
to fall,
we saw
it triggered
is a
what are
stark
called
reminder
margin
that
calls.
silver should be one
This is
part
basically
of
the
the broker
portfolio
saying,
not your
hey,
entire portfolio.
your position is losing too
You
much
have
to
to
go
go
into
into
it, understanding that these
short-term
short-term swings are just
will
part
sell
of
your
the game.
silver to cover the
Panicking
losses.
is the enemy.
This
Finally,
forced
to navigate
liquidation
this,
creates
you
a
must keep a
brutal
close
domino
eye on the
effect.
bigger picture.
As these big players were
Watch
forced
those
to sell,
macroeconomic factors
it
we
flooded
talked
the market
about,
with sell
the
orders,
strength of the dollar,
pushing prices
Federal
down
Reserve
even
policy,
faster,
industrial
which in turn
demand for
triggered
silver
more
and new
margin calls for other
technologies,
traders.
and any
It's a
geopolitical
vicious
cycle
cycle
on the
that could
horizon.
turn
Correction into a
These are the
catastrophic
underlying
collapse
currents
that
in
will
a matter of
ultimately
hours.
drive the price, long after the noise of today's headlines has faded. By understanding these drivers, you can anticipate potential moves instead of just reacting to them. So, in short, today's shocking crash is not a definitive sign that silver's bull market is over. Far from it. Instead, think of it as a test of investor discipline. It's a real-world illustration of how markets work, and it's a chance to prepare for the next phase of this ongoing story. For those who watch closely and act wisely, today's dramatic drop may simply be the pause before the next surge. It offers both a valuable lesson and a potential opportunity. Thanks for watching, and be sure to subscribe for more market analysis.